Hello, I'm joined here today by Andrew Bell, CEO at Witan Investment Trust, to talk about half-year results for 2021. Hello, Andrew.
Hi, Sophia.
So 2021 has been a bit of a rollercoaster of the year. We had lockdown, we had the vaccine, and now we have restrictions easing. How has the market and Witan performed in that environment?
Markets have been very variable following the ebb and flow of the epidemic and the rollout of the vaccines across different countries at different paces. The first quarter of the year, what you call recovery stocks, the cyclically exposed value stocks, performed very strongly, and technology was left in the dust with rising bond yields, and also because technology had such a good year last year. The second quarter of the year, broadly speaking, those moves reversed and technology caught up quite a bit. And the US outperformed in the second quarter, underperformed in the first. And so reflecting that, our own managers had differing performances. Our portfolio performance was ahead of the benchmark in both quarters, actually a little bit better in the second quarter. And I think that reflects the fact that we don't have a dominant style within the portfolio. So at the mid-year mark, we were up about 12.5%, 12.4%, which was about 1% ahead of our benchmark index, which I think is decent, although we'd like to do better.
And what were the drivers of Witan's outperformance?
The portfolio overall performed, broadly speaking, in line with our benchmark. Taking together the managers, stock picking was a bit difficult in that period. The effect of falling gilt yields was beneficial for the valuation of our debt. Buybacks added a little bit to NAV. So in the round, those were about flat. But we carried quite a bit of gearing into the beginning of the year because we had a high conviction that the markets were oversold and had good recovery potential, assuming the vaccines worked as they were expected to. And so we carried 10 to 12% gearing through most of the first half of the year. And if you're geared into a period of rising markets, that's a tailwind for returns.
So last year, we saw the dominance of tech companies and companies that were able to do well in the pandemic outperform. This year, we've seen companies and sectors with value characteristics outperform. How have Witan managers done this year?
Well, to a significant degree, those that did badly last year have done rather well this year and vice versa, which reflects a little bit the change in market fashion from the COVID beneficiaries, the tech stocks and the growth defensives that did very well last year. It's not that they haven't done well this year. The corporate news has been good, but clearly the spotlight moved on in performance terms to those that had more exposure to recovery in economies. And so, for example, Lansdowne and Artemis and our portfolio of direct holdings have done quite well this year because they had a significant exposure to cyclical recovery, whereas some of the others, such as Jennison and Lindsell Train, which were more exposed to growth themes, have done less well simply because the share price spotlight was elsewhere rather than because the companies themselves haven't done well.
And Witan made several changes to its managers last year, moving to a core and specialist portfolio structure. Have you made any further changes this year?
It's been a much quieter time. We've only changed one manager, which was we had a portfolio in Asia Pacific managed by Matthews International, and we decided to close that down in the spring for two reasons, really. The first was that we were able to get Asian exposure from our emerging markets portfolio and also from our global managers who can buy stocks in that part of the world. And the other was that we felt that we wanted to reduce our exposure to Asia and increase our exposure to the North Atlantic markets because the recovery and the vaccination rollout were further advanced over here. So we used the monies taken from the Matthews portfolio in April to increase our US exposure at the time.
So has there been any recovery in dividends for 2021?
The start of the year was relatively weak for dividend growth because at the beginning of 2020, some companies were still paying dividends from 2019, whereas at the beginning of 2021, there were some follow-through cuts from the difficult operating conditions in the pandemic year of 2020. But from about April onwards, dividends have begun to improve for our portfolio and the markets as a whole. Companies have reinstated or increased dividends, and we've seen that more recently in the interim reporting season, which holds quite good promise for 2022. So taking the first half as a whole, our revenue earnings per share were about 9% ahead of the previous half-year period a year ago. And if anything, that trend appears to be accelerating. So I'm quite hopeful that the picture for 2022 over 21 will be better than for 21 over 20.
And in your last half-year report, your chairman said that Witan was continuing to integrate ESG into the investment process. What have you done in this area?
Well, last year we signed up to a number of international memoranda concerning sort of responsible and sustainable investing, such as the UN Principles for Responsible Investing. And one of the things that that has led to is a more formal engagement with all of our managers, both to check that they have a robust process to ensure that they are taking account of all of the relevant risks in their portfolio. And also when we see individual companies in the news for the wrong reasons, we check that they're holding their companies to account and that their reasons for holding them are that even if a company's not doing well, they're on a path to recovery. And so that's on the portfolio management side. We've become much more structured in how we approach these things. On the public disclosure side, there's a lot more information in our annual and interim reporting on our ESG practice. And we've also just recently completed our first annual report for the UN Principles of Responsible Investment and waiting for their comments on it. And for future years, those reports will be in the public domain. So we'll be very transparent what we're doing in detail against the responsible investment goals.
So we see now that the world is hopefully going back to normal after the pandemic. What do you think are going to be the key investment themes going forward, and how is Witan's portfolio poised to take advantage of those themes?
I think one of the themes we're beginning to see, but it's a slow starter, is we're going to see a broadening of the economic recovery and stock market strength from the very narrow range of sectors we had last year, dominated by the US market. There are signs of that being shared by other markets. The UK and Europe have been more competitive with US returns this year, though it's been very stop and start from month to month. So I think we're going to see a broader range of sectors and economies participating in the stock market recovery. We've clearly had a year last year when all the focus was on growth stocks. We had a few months at the beginning of this year when all the attraction was towards companies geared to recovery. And I think in future it's going to be more balanced, that people are going to be looking for unrecognized growth. Clearly it's going to be, we're living through an age when there's a lot of creative destruction, as the economists put it, both from technology, which has been around with us for a while, the Amazonification of retail and of property and so forth. And now increasingly, I think climate change is going to come in as a similarly disruptive influence, because the political and economic imperatives to take measures, in a way to force measures on society and on the corporate sector to mitigate and head off the worst effects of climate change, are going to mean that a lot of business models which might have looked robust in the past are going to come under threat. So you need to be sure that you have an adaptable portfolio. The sort of buy and hold, the portfolio of blue chips that might have worked for most of the last 20 or 30 years is going to be increasingly dangerous, because you don't want to be left holding a portfolio of, say, retail and old-fashioned offices in the age when technology is making a lot of that redundant. And you don't want to be left holding a load of, if you like, metaphorically, straw huts and igloos in an environment of global warming.
And finally, what is your outlook for the rest of 2021?
I'm quite optimistic on the economic front. As the vaccine rollouts take effect, it's clearly so far the process of economic reopening has been continuous. It's been relatively slow to get going, but it seems to have been largely without major reversals. So economic growth is picking up from very depressed levels. And so probably the most rapid period of economic growth is as we speak, or in the recent past, because if you're going from very depressed levels, there have been 5 or 10% growth rates for several economies. But I think we're going to see a sustained period of above average economic growth, because we're recovering from the pandemic against a background of record low interest rates. So that eases the financing problem for companies and individuals. As fiscal policy is still very powerfully stimulative of growth. We've had big measures in the US, tax cuts and tax holidays in different parts of the world, incentives to invest over the next year or two. And on top of this, the priority being given to measures to electrify the economy, if you like, to try and phase out fossil fuels, is adding a non-economic imperative to spend money now to improve our fortunes in decades to come. So I expect that economic growth over the next year or two is going to be above average, not like 5-10%, but like 3-4-5% potentially in some of these economies. and there are going to be good benefits for that for corporate profits. So as we go through the second half of the year, there will be intermittent worries about bottlenecks in the economy, because there's been so much disruption to trade. So you get bottlenecks holding back, as we've seen with the car sector. They've been held back by a shortage of chips. But those bottlenecks, I think, will gradually work their way out as the economy's muscles, as it were, start to unstiffen. And I think there will be an increase in inflation from the very depressed levels close to zero over the last few years. My instinct is that most of the increases in inflation are going to be transitory, but over the next 5 or 10 years, I think the average inflation rate is going to be higher than over the last decade, because governments and central banks appear to be prepared to see inflation overshoot. And I'm going to take them at their word. If they're going to allow inflation to run 1 or 2 points higher than they would normally have done in the past, I think we will see higher inflation. That's a major threat for bond markets, because bond yields are almost zero. So any inflation is effectively eating up all of the return you'll get from bonds. For equities, it's a bit yin and yang. There are some parts of the market that will do well, because if the economy is growing and if there's a little bit of pricing power, companies will be able to grow their profits more easily. Other parts of the market will do less well, because they're on very elevated ratings. And if government bond yields rise, then the rating on some of the most highly rated parts of the market is likely to come down. So I think it's going to be necessary to be more selective. You can't just rely upon a rising tide to float all the index levels up. I think having an ability to identify those companies which are growing their earnings at an acceptable valuation is going to be more important than over the last 3 or 6 months.
Unfortunately, that's all we've got time for. Thank you, Andrew.
Thank you.